Hello and welcome to our weekly market roundup, your one-stop source for the latest in global market trends, key economic insights, and top financial news. I'm your host Daniel, bringing you the highlights and the happenings from around the world. Last week, global markets responded to US election results, central bank rate adjustments, and new stimulus measures in China. Here's a look at the main developments across key regions and what's on the radar for the week ahead. US markets surged last week as a Republican-led sweep fueled optimism for growth-oriented policies, potential tax cuts, and regulatory easing. The Russell 2000 led the gains, soaring 8.57%, with the S&P 500 also advancing 4.66% to near record highs. The Nasdaq added 5.74% as investor sentiment remained strong. The Federal Reserve implemented a 0.25% rate cut. Treasury yields saw fluctuations, with the 10-year Treasury yield briefly reaching 4.48% before settling around 4.30% on Friday. Meanwhile, the ISM Services Index climbed to 56, indicating robust expansion in the services sector despite ongoing supply chain challenges. The services sector remains a bright spot for the US economy, as inflation pressures ease and consumer confidence continues to strengthen. European markets posted declines, with worries about US trade policies and weaker corporate earnings weighing on sentiment. The Stoxx Europe 600 dropped 0.84%, while Italy's FTSE MIB and the UK's FTSE 100 fell 2.48% and 1.28%, respectively. In the Eurozone, the latest PMI data was revised slightly higher to 50 in October, indicating economic stagnation rather than contraction. But business confidence has reached a year-to-date low. Meanwhile, Germany's government faced political upheaval, which added uncertainty to Europe's economic outlook. The Bank of England cut its key interest rate by 0.25% as inflation continues to moderate, with Governor Andrew Bailey signaling that gradual rate reductions could continue if economic conditions warrant. Japan's Nikkei 225 rose 3.8% last week, driven by optimism over stable currency expectations and favorable US policy outcomes. The yen appreciated slightly, ending the week around 152 against the dollar as investor sentiment improved. Japan's 10-year government bond yield reached 1% amid speculation that the Bank of Japan may consider a rate hike in early 2025. Economic data showed mixed results, with real wages declining while nominal wages remained steady with inflation. Household spending fell by 1.1% year-over-year in September, but this was a smaller decline than expected, suggesting resilience in consumer demand. Chinese equities surged after the government introduced significant stimulus measures, with the Shanghai Composite up 5.51% and the CSI 300 gaining 5.5%. China announced a 10 trillion RMB debt refinancing plan to address local government debt and raise the local government debt ceiling to boost economic stability. October exports surged 12.7% year-over-year, driven by favorable weather and strategic discounting to increase demand. This export growth, along with the latest fiscal measures, bolstered market confidence and suggested that China's economic recovery may be gaining traction. As we look ahead, several major events are set to shape global market movements this week. US October's CPI data will be essential for assessing inflation trends, as the Fed considers further rate adjustments based on cooling price pressures. US October's retail sales report will reveal consumer spending patterns crucial for evaluating US economic strength heading into the holiday season. Eurozone industrial production will provide insights into manufacturing activity across the Eurozone, helping gauge economic resilience amid moderate inflation and growth concerns. Japan's preliminary Q3 GDP figures will indicate growth momentum as the BOJ weighs future policy normalization efforts. China's foreign direct investment data for October will offer insights into investment confidence, particularly as the government moves forward with substantial stimulus measures. That's a wrap for this week's Market Roundup. Thanks for tuning in. Be sure to subscribe and hit the bell icon to stay updated with the latest market news and analysis. Until next time, stay informed and stay ahead. I'm Daniel, and I'll see you next week.